Welcome to our comprehensive guide on understanding the crucial differences between private and public markets. In this video, we'll break down why these two pillars of the financial world matter, how they operate, and who the major players are. Why should you care about the nuances between private and public markets? Whether you're an investor, an entrepreneur, or a finance professional, grasping these distinctions is fundamental to navigating the global economy and making informed decisions. At their core, private and public markets are the two main pillars supporting the global financial landscape. They each serve unique purposes, but together, they form a complete investment ecosystem. These markets cater to different stages of a company's growth cycle and address a variety of investor needs, from early-stage funding to large-scale liquid investments. Understanding their fundamental differences is key to constructing a balanced investment portfolio, allowing you to effectively manage risk, target desired returns, and consider liquidity requirements. First, let's define the private market. This sector involves direct investments in companies not listed on stock exchanges, including private equity, venture capital, private credit, leveraged buyouts, and investments by family offices. Private equity, or PE, focuses on acquiring or restructuring established companies with the goal of enhancing their value and then selling them for a profit, typically over a medium to long-term horizon. Venture capital, or VC, provides crucial early-stage and growth-stage funding to startups and innovative companies, often in high-growth sectors like technology and biotechnology. Private credit involves lending activities that occur outside the traditional banking system. This includes direct lending to companies, mezzanine debt, and other specialized financing solutions tailored to unique borrower needs. Buyouts, particularly leveraged buyouts, involve private equity firms taking controlling stakes in mature companies, often using a significant amount of borrowed money to finance the acquisition. Family offices are private wealth management advisory firms that serve ultra-high net worth individuals or families. They often invest directly in private opportunities, focusing on long-term growth and capital preservation. Now let's shift our focus to the public market. This is where publicly traded securities, like stocks and bonds, are bought and sold on regulated exchanges, accessible to a much broader range of investors. Stock exchanges like the NYSE, NASDAQ, India's BSE, and NSE are the central platforms for trading listed securities, providing a marketplace where buyers and sellers meet. Listed companies are public corporations that issue shares to the general public. They are subject to strict regulatory oversight and disclosure norms, ensuring transparency for investors. Mutual funds are pooled investment vehicles managed by professional fund managers. They allow retail investors to gain diversified exposure to various asset classes with relatively small capital. ETFs, or exchange-traded funds, are similar to mutual funds but trade like stocks on exchanges. They are known for their flexibility, transparency, and often lower costs, tracking specific indices or sectors. Ultimately, public markets are designed for broad accessibility, high liquidity, and stringent transparency, ensuring fairness and protecting investors through comprehensive regulation. Now that we've defined both, let's explore the major differences that distinguish private and public markets. One of the most significant differences is liquidity. Public markets offer daily trading and immediate cash conversion, while private markets require long holding periods, often 5 to 10 years or more, before an exit. Transparency and regulation also differ significantly. Public markets face strict regulatory oversight by bodies like the SEC, ensuring extensive disclosure. Private markets, by contrast, are generally more opaque and less regulated. Valuation methods diverge as well. Public market assets are priced in real time by supply and demand. Private market assets, however, are valued less frequently, relying on complex models and expert appraisals. The investment horizon is another key distinction. Public markets allow for short-term trading and speculation, whereas private markets demand patient, long-term capital due to the illiquid nature of their investments. Private markets often target higher returns to compensate for their illiquidity and higher inherent risks, while public markets generally offer lower potential returns but with greater stability and liquidity. What are the primary drivers behind the operations and appeal of each of these markets? Private markets are driven by factors such as flexibility in structuring deals, greater control for investors and managers over company operations, and a hands-on approach to strategic value creation. Public markets are driven by their immense scale, enabling trillions of dollars in daily transactions, unparalleled liquidity for both retail and institutional investors, and broad accessibility through low-cost entry points like ETFs and mutual funds. It's important to understand that both private and public markets are not mutually exclusive. They are vital and interdependent components of the global financial ecosystem. The private market is crucial for fueling innovation and early growth. It provides the initial capital that transforms groundbreaking ideas into viable businesses, nurturing them through their nascent stages. Conversely, the public market offers essential liquidity and enables mass participation, allowing a wide range of investors to own a piece of established companies and participate in economic growth. Both markets complement each other. Private markets create the future public companies through venture capital and private equity, while public markets recycle capital back into private funds, creating a dynamic and interdependent financial ecosystem. Let's look at some of the biggest players in the private markets, the firms that wield significant influence in this less visible but highly impactful sector. Blackstone, KKR, Carlyle, and Apollo are global leaders in private equity, real estate, and private credit, managing massive portfolios and executing some of the largest private transactions. SoftBank Vision Fund, particularly prominent in recent years, aggressively funds technology disruptors globally, playing a significant role in shaping the future of various industries. Sequoia Capital is a legendary venture capital powerhouse known for backing some of the most successful startups in history, including Apple, Google, and Airbnb from their earliest stages. Now, let's identify the biggest players in the public markets, the exchanges, and the asset managers that facilitate and dominate global public trading. The NYSE and NASDAQ are the world's largest stock exchanges, home to countless iconic companies like Apple, Amazon, and Microsoft, acting as primary venues for global capital formation. In India, the BSE and NSE are the leading exchanges, powering domestic equity growth and providing vital platforms for local and international investors alike. Vanguard and BlackRock are passive investing giants, collectively controlling trillions of dollars via their extensive range of ETFs and index funds, democratizing access to public markets for millions. The interdependence between these markets is evident in how companies transition from private to public. This often happens through initial public offerings, or IPOs, or more recently, through special purpose acquisition companies, known as SPACs. In summary, private and public markets play distinct but complementary roles in the global economy. Understanding their differences is crucial for any investor, entrepreneur, or finance professional to make informed decisions. Remember, this video is for educational purposes only and not financial advice. Thank you for watching.